Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending February 26th, 2021. So, as usual, I'm joined with our chief economist, Clément Gignac. So, good morning, Mr. Gignac.
Good morning, Sebastian.
So we had a very eventful week in the market, so we'll try to make sense of all of this. So let's start with the facts. Interest rates are rising fast and are even accelerating up. So negative returns on bonds. So the universe index down 1.3%, the long index minus 1.8. Year to date, as you can see, between -3 and close to -10% for bonds. So we mentioned that last year at the beginning of the year. One of the risks that we saw this year was that interest rates were going to go higher with the vaccination campaign, stimulus, more growth, more inflation. Well, markets tend to move quicker than we think sometimes. So the move has been quite violent, to say the least. Of course, when you have such violent moves in interest rates, it's not good for equities either. So this week we had the negative returns on equities. What had the best returns recently were the worst hits. So emerging markets, Nasdaq 5.5% lower. After that, you have the S&P 500. Then you had still more muted move on EFI, so Europe and Asia, and on the TSX. Year to date, you're still positive on equities, but this week was a big week for the stock market. Other markets, the price of oil higher on good economic news around the world. Canadian dollar was higher, euro was also higher, and gold continues to be volatile at 1770 this week. So an update on COVID. On the left, you have the current hospitalizations in ICU, so in intensive care units. As you can see, we've made lots of progress recently, so that's the good news. On the right, the better news is that the vaccination campaign, the widespread vaccination campaign has started in Canada, so we know that we'll have millions of doses coming on all the way through the end of March. And even this morning on Friday, we learned that the AstraZeneca vaccine has been approved and that there's 1 million doses that should be coming by the end of March of this one, on top of the other millions that were that we discussed in the last few weeks. So we should see a strong acceleration in vaccination. So that's a good sign that should support growth in 2021. Talking about growth, Canada versus the US, here we have the consumer confidence. On the left, you have the US consumer confidence, which is bottoming. On the right, you have the Canadian consumer confidence, which is back to where it was prior to the COVID. So as I mentioned, with vaccination campaign coming in, the spring coming in, so we should have less confinement measures. So that should help confidence in Canada. But if we focus on the US, consumer confidence seems to remain very low. But now we have lots of stimulus in. You have a vaccination campaign that's accelerating. And this morning we had the personal spending data coming out for January. And it showed that with the checks that were sent to households from the 900 billion package that was agreed to during Christmas time, that was enough to push the savings rate in the US from 13% to 20%, which is an all-time high, excluding the early COVID period. So savings rate is really high. So there's lots of spending, of pent-up demand for consumer spending. And we know that today, the House will be voting on the 1.9 trillion package, which will add $1,400 for most Americans. So lots and lots of stimulus coming in. So the savings rate could go all the way to 35, 40, 50% in the next few months. So lots and lots of spending demand. And with vaccination campaign and the reopening of the economy, there are many good reasons to think that confidence will jump. The U.S. growth should be 5 to 6% this year on GDP. So we do expect a very strong year out of the US. So bottoming confidence, but we expect a much more confident US consumer and with lots of money in his pockets in the next few months. Looking at housing in Canada, we're already seeing signs of overheating. As you know, we had some macroprudential measures that were put in place by regulators in 2016, 2017 because the market was exuberant. Now we see this more signs of overheating overheating on the left, the home price surge, the share of regional markets where prices rose by 10% or more in the last 12 months. As you can see, Canada, the red line on the left chart, we're even above the 2016-2017 peak. So that's an all-time high. And on the right, the share of vulnerable borrowers defined by a loan-to-income ratio greater than 450% were even higher than we were in 2016, 2017. So we're starting to see signs of overheating. So lots of confidence, low interest rates, change of habits, the exodus to the suburbs, all of those factors in. And in the US, we would bet that on the left, we will see the blue line jump also with confidence jumping and more money in everyone's pockets. So maybe we can see some macroprudential policies, but it's a good sign of confidence and of more economic growth coming, because when you buy a house, there are some multiplier effects there. So that's a good tailwind for the North American economy. Finally, on the economic part, the Fed this week is pretty adamant that they say that inflation is soft. They're committed to their current policy. On the left, I put a chart. This is a forecast from Nomura. This is not ours, but even some economists are saying, well, yes, in the short term, inflation will be stronger, but then it'll fall, and there's no need to worry. The Fed is in that camp, but the market this week at least strongly disagrees with the Fed, so that explains the market movement. So to make some sense out of all of this, I hand it over to you, Mr. Gignac, to explain it to us.
Yeah, so thank you. Very interesting what you mentioned. I think about that saving rates at 20%. So it's amazing the pent up demand, and that not include the new checks that they will receive money additional. So wow. Okay, so yeah, of course they have a lot of action on the bond market. So the next slide. So make no mistake, we do not expect any short rates increase, the discount rate or Fed funds from the Fed this year or next year, okay? But it's just that even if the banks doing the right thing, they have done the right thing, the central banks, they do the right thing as we speak, the market is skeptical, and I'm skeptical too about their vision, their forecast that, you know what, we will maintain the Fed funds at zero for the next 3 years. So the market seems to believe, wait a minute, okay, this economy is very strong, vaccination campaign accelerate, and you have referred to the saving rates now, huge pent up demand out there. So the markets question their optimistic view about the fact they will maintain interest rates so low. And they question as well their view that this inflation acceleration this spring is only transitionary, and they will return low and they will have difficulty to return to 2%. So all of that, it's a game changer, COVID-19. We shift from global supply chain to local supply chain in many aspects. We have some cost push of commodities, transportation costs, delivery. You have to wait much more to when you order something. This is a recipe for some push. So notice on the right side, this is now what the market expect in terms of rate hikes, and the market now expect that it will be starting in early 2000 in 2023, not 2024, in 2023 the first hike, the second hike in September. So they challenge the commitment of the Fed to keep interest rates so low. Notice on the left side, this is a yield curve, the 30-year compared to the 5-year. Why? Because 30-year, the Federal Reserve do not control too much the 30-year. The 5-year is more influenced beyond the QE, is influenced as well by the short rates. So notice the spread between both. Now it's a skyrocket. It's 160 basis points. You have to be back to 2004, the 14, excuse me, the last time that you have seen that. So the 10-year bond yield has increased by 50 basis points in 2 months. Nobody, including ourselves, thought that it would be so fast. I remember Sebastian and myself in December, January, we mentioned that one of the biggest risks of the market is the repricing of the bond market. They have too much complacency. Guess what? It's happened much faster than what we thought. As a result, on next slide, suddenly Wall Street take notes because with this 10-year bond yield shift from 1 to 150 in 2 months, suddenly the so-called TINA, there's no alternative to stocks. Wait a minute, notice now the 10-year bond yield is the same level now than the dividend yield on the S&P 500. Of course, a lot of folks do not buy equities US for dividend, but guess what? When the long rates increase fast, since technology stocks it's a long duration, that hurt more technology stocks. We have one of the worst week in many months, and suddenly we have this situation that people has gone to others. So we will see, but clearly now it's a possibility that looking ahead, that suddenly equities have a little bit more competition from bonds, and probably the big pension plan who rebalance on quarterly basis. Probably in March they will start to rebalance and start to buy a little bit more bonds, a little bit less stock. So we will see, but it's not over yet. And the fair value of the 10-year bond yield is not 150. It's closer to 2%, a quarter, from my point of view, when the U.S. economy will run at full capacity and the core inflation will exceed 2%. So this story of repricing of bond market is not over yet. It's just to inform you. Nonetheless, they have still opportunity, but check what happened. This increase of long rates on next slide. So suddenly, the growth stocks, what it means, for example, growth stocks, technology stocks, for the first time since 2000, check the February this month. This morning in February, it's Friday, the technology stocks rebounds, but nonetheless, we're heading for the worst month, okay, in terms of underperformance of growth stocks compared to value stocks, because this is what is about the first slide on the left. So the performance of growth stocks compared to value stocks. So it's 7-8% underperformance. You have to be back to 2000, late 90s, early 2000, when the dot-com bubble been bust, that you see such underperformance. Okay, it's not necessarily a bubble on the Nasdaq, but it's very rich. Valuation are very expensive, particularly with long rates start to increase, and when people will start to spend again, the earnings from value stocks will grow at faster pace at some point than earnings on from growth stocks. You will have a rotation. So this is something to watch. Talking about sector rotation, notice on the right side you have two curves back to February last year. The blue one is the S&P 500 barometer, and the pink, I think it's pink, the pink curve is banking US. So until last October, November, really banking stocks underperform the S&P 500 big time, at some point by 30% underperformance. But now notice what happened since early November, since Biden been elected. Democrats spend a lot, as Sebastian explained. Now, for the first time since the beginning of the pandemic, now banking stocks US perform as well as the market. So this is significant, and possibly since the beginning of the year, this is what happened. Energy stocks, banking stocks, they have a huge sector rotation. This is what we have talked about many times with these weekly capsules in the beginning of the year, to diversify, to reduce technology stocks, the FANG, and increase the energy stocks and the banking stock. This is Sebastian and myself, what we have done as well in our portfolio that we co-manage. And finally, the next slide, to finish with some optimism. Yes, of course, this market rally is significant. Okay, notice if you compare the dark line, it's in fact the black curve, excuse me, is the current rally since the trough, 70%. Could you think about that? If you compare that to the great financial crisis recovery or 1982 big recession recovery, it's pretty similar. So from now on, don't be surprised, that you will see more bumpy ride, and but there are still few left in the tank, but you could probably see more correction and drawdown from time to time. On the right side, this is the experience when you have a new bull market like this one started. The first year is very impressive. The result, notice, in average 42%. The second 12 months, because when we talk about year, it's not necessarily civil year, it's is the 12 months following the trough. And notice the second column is the second year. So it's more modest, but still interesting, and double digit, 12%. But then it is a drawdown. So you have to be ready, okay? If you believe, like us, that the bull market is not over yet, but you have to be ready to experiment bumper ride and some correction. And if this week, for example, you have difficulty to sleep due to the fact that Nasdaq has done bumpy ride, maybe you have just too much stocks. Nobody getting poor to take profits. So we invite you to talk with your advisor, financial advisor, to revisit maybe your portfolio given your objective and your risk tolerance. So I've been long a little bit, Sebastien. My apologies for that. We have a lot of things to watch next week.
Yeah, thank you. No, you weren't long at all. It was a very eventful week, so lots of useful information there. Canada next week will have the GDP for January, which will be the main point. We should have a bit of a contraction versus December because of all of the confinement measures that we put in place in January. So we'll be following that. In the US, many data points from the services sector, manufacturing sector, we know it's going pretty well down south, but we'll be looking at the change in non-farm payroll, so the jobs report. A small 133,000 jobs should have been added in February, so not enough maybe to change the needle, but at least jobs added is better than jobs shed. So we'll be following that. And the unemployment rate higher at 6.4, but from 6.3 in January. So we'll see if there's any strong move there in the unemployment rate. So that wraps it up for the week. If you want to reach us, ia.ca/economy. If you haven't done so, you can subscribe to our newsletter. If you want a copy of the PDF copy of this presentation, you can write at economics, ICS at the end, at ia.ca, and we'll send you that. So thank you everyone for your participation. Thank you, Mr. Gignac, for your knowledge.
You're welcome. Have a nice weekend. And spring is coming. Next Monday, it's March.
Yeah, we're headed that way. So thank you very much, and we'll be back next Friday with a new edition of the Weekly Economic Review.